They don't produce inflation for one simple reason. They do not own a printing press on which you can turn out green pieces of paper. The only such printing press is in Washington. I say printing press, of course, in the modern age, we do it in a more sophisticated way. We use bookkeepers and accountants and computers. But it comes down to the same thing. Inflation is made in Washington because only Washington can create money. And any other attribution to other groups of inflation is wrong.
Welcome to Key Stock and Crypto channel. Don't forget to like and subscribe to the channel.
And we're back on the Crypto channel, guys. The Patreon is going to start in February. Everybody said they didn't want to start during the holidays, so we're going to start it in February. But guys, we know 2023 to 2025 is going to be a wild ride, and especially for stocks. Remember, the legacy market is going to be destroyed, and these stocks are going to be tokenized and put on blockchain. So therefore, they'll be able to be fractional. But we had the stock market up at the beginning of the morning, pulled back, and that is because of the higher yields and higher dollar. But we're going to go over that later. But guys, we have the FOMC meetings. And guys, we have to keep our eyes on the Fed because they're going to let us know where these stocks are going. So, of course, right now we have February 1st and March. We have May, June, July, and then we have September, November, and December. And we know they're going to pause either during the summer or going towards the fourth quarter. And we know these big corporations pay that 15% tax this year. So we know they're going to be pricing it in. We already see the layoffs happening. Now we have UBS says don't buy stocks right now. I'm not your financial advisor, not financial advice. Please do your own research. But I definitely agree because I do see the Fed raising rates for February and March. Maybe only 25 basis points, but remember, they're starting to roll off the balance sheet and all the central banks are moving in lockstep. Remember, guys, we have a global economy. And we have Jim Cramer says it's the last time to get out of Chinese stocks and cryptos. But guys, we know the emerging markets, if you're an investor, are going to be the winner at the end. We know all about the fourth industrial revolution. If you don't know, go to my main channel, Crypto Teacher, because everything is going to be tokenized and put on blockchain. Robots, algorithms, and drones running the economy. And we saw China stocks get a great lift. So we know most likely they will pull back in the short term. But if you're looking 5, 10, 15 years down the road, you're going to be fine. Now, guys, make sure you're paying attention to the actual earnings calendar. Majority of the big tech is before the rate hike. And we know the Fed likes to price things in. So on my Crypto Teacher channel, I told you that January was going to be a pretty good month because the Fed was not meeting. But I definitely see February as pulling back in stocks and cryptos. And then also they're going to price in for March. And we know when earnings come around, that's when we get our biggest pump and biggest dump. Now, even though stocks are going to take a beating in the U.S., guys, you still have sectors that are still going to be making money because people still need it. We know people are still going to need health care. And then also, guys, we know this energy push. So we see stocks like First Solar still maintaining. Now, back in November of 2022, we had Biden sign the medical marijuana research bill. So, guys, we know about 12 to 18 months, things are about to change in the industry. And right now, these stocks are back close to their lows. And we know the Republicans have taken over the House. So you should have had plenty of time to stock up. Now, we had yield rates rise late. We had the dollar rise slightly. And we had the VIX slightly up. And if you notice, guys, there has not been much volatility. The VIX has stayed around in that 20 range. And we know soon, February and March, it'll be back in the 30s. These indicators don't lie to you, and we know we're going to have that pullback, but we know the Fed is going to pause. And as soon as they pause, We know that's going to be good for stocks and cryptos. But guys, that's all I have for you. Have a wonderful day.
It's your ultra high net worth clients that are wondering whether this year is going to feel as rough as last year.
Well, investors have come off a beating last year where the markets took a $30 trillion hit. Global equities down 19%, global bonds down 16%. That coupled with the Russia-Ukraine war, 7 rate hikes, and obviously 40-year highs in inflation in June last year. So it was a really tough environment last year. And we primarily did 4 things for clients. At the start of the year, we did a lot of hedging, so both on the asset and the liability side. We moved a lot of cash into fixed income, which was a very compelling trade, which we're still doing right now. We shifted equity positions into high-quality dividend-paying equity positions. And for suitable investors, we added a lot of alternative investments. Think private equity and hedge funds as well. And now, as we're sitting at the start of 23, it's going to be a very different year than 22, and I think there's going to be a lot of opportunities ahead for investors.
Why? What is going to be so different about this year?
Well, we are projecting a recession, hopefully mild, in the first half of the year. And as you and I both know, bear market bottoms are never hit until a recession starts. So therefore, we think investors still need to buckle up for a lot more volatility and potential downside in the markets in the months and weeks ahead. So there will be some more opportunities there for sure. But nonetheless, we think there's a lot of opportunity because we think rates will peak and we think inflation will come down to roughly 3.5% by the end of the year. Not to mention China's open.
Hey, Becky, yeah, the Fed is supposed to be listening to the data, be data dependent, but it's sounding a little tone deaf these days. Wage growth, as you said, slowed. Inflation is down, but Fed rhetoric remains as hawkish as ever, focused almost solely on the inflation risk, not the economic risk. Bostic said, Atlanta Fed President Raphael Bostic telling us there's more work to do. Esther George on Wednesday told us that the 5% rate should go well into 2024. Tom Barkin on Friday said the inflation fight isn't over. And the Minutes on Wednesday told us that no official is expecting cuts in 2023. Meanwhile, the ISM service sector contracted. December wage growth slowed. November was revised down sharply. That was the one everybody was scared about. 5-month annualized inflation is running around 2.5%. To be sure, the unemployment rate did fall by 0.2, but here's how the market reacted to all that data on Friday. The 2-year fell in 2 steps from the jobs number and then again ISM services, a sign that it sees both the inflation and the economic weakness that's out there. You couldn't see that kind of drop in the Fed rhetoric anyway. The appearance, at least by looking at the comments, is that Fed officials are not really data dependent. Instead, it looks like they've got this idea in their head to go to 5% or higher almost no matter what. Charles Calamaris, a former Columbia professor, talked to him over the weekend. He said, what's strange at this moment when things are so ambiguous is for the Fed to be acting like their actions are so predictable. The Fed may have it right. Inflation is a persistent threat, and there's been no progress to warrant a backing off. That may be correct. Or they may be making a mistake similar to the one they made last year when nearly all decided, wrongly of course, that inflation was transitory. Rather than a debate and different takes on the data, they all sound like they're talking or singing from a script that is ignoring the data. Becky?